Welcome back for another episode of Tide 10. Tide, for those that don't know, is the Investment Diversity Exchange, and its mission is to promote diversity and inclusion within the investment management industry. Through its flagship conference and various other events and connections, Tide seeks to highlight a diverse set of industry professionals and their important contributions. Tide also aims to focus on the importance of adopting policies and building partnerships that heighten women and minorities' role and influence in the industry, while bringing together the best minds in the industry to discuss issues facing our industry today. I am Quyen Tran, Director of Investor Relations at Sightway Capital, Two Sigma's private equity investment unit. I'm joined here today with Mark Steed from Arizona's Public Safety Personnel Retirement System. By way of brief introduction, Mark Steed is the Chief Investment Officer for PSPRS, Arizona's pension plan for first responders. Over the last 10 years at Arizona, Mark has managed private equity, venture capital, absolute return, opportunistic credit, public equity, global trading strategies, and real estate portfolios. His creative approach and notable performance across disparate asset classes won him recognition as a rising star by Money Management magazine and later Asset Allocator of the Year by Institutional Investor. Mark also served a 4-year stint as a forecaster for the distinguished Good Judgment Project and published the first guest post on the popular decision science blog, Barnum Street. Prior to Arizona PSPRS, Mark worked in banking at JPMorgan Chase. Thanks, Mark, for joining us today.
Yeah, no, my pleasure.
PSPRS's motto is serving those who serve others. How do you view your role as allocating on behalf of the first responders in Arizona?
Yeah, that's a good question. It's difficult because, on the one hand, I take negotiation very seriously, right? Because you're speaking, you represent police officers and firefighters, and the reality is that they put themselves in harm's way. And I just don't personally feel like people like that, should have to beg for things. And I don't think the people that represent them should have to beg for things either. Mm-hmm. So there's that sort of serious aspect to it. The constituents of our plan are cops and firefighters, they're judges, and they're corrections officers. So if you screw it up, the person that arrests you, the person that tries you and locks you up are all members of the system. So that, there's that reality. As it has to do with, sort of ESG, minority investing, I've always taken the view that it's not my money, and, it's an individual choice. And we have 55,000, 60,000 members. They're represented by a 9-person board. The conversation comes up, and I don't push them one way or the other. I always see my view as just giving them information. If you want to invest in this or you don't want to invest in this, here's the likely outcome. But the reality is, if they want to do it a certain way, that's their call. And that's always how I thought about it.
So I noticed that the PSPRS's private equity portfolio has performed very well, ranking in the top 10 of public pension funds. So congrats on that. I'd also
got a lot of mileage out of that.
Yeah, I'd seen that you had actually pioneered the first private equity program in your early days at PSPRS. So this must be a bit of a baby for you. What do you give credit for that success? And conversely, where do you see room for improvement?
We were really successful because we started building private equity and venture in 2008. So there couldn't have been a better time.
Yeah.
And we as a pension are cash flow positive. To be in a cash flow positive position when prices were 30 or 40% off, I think just naturally sets you up, right? It's beta.
Sure.
And when you put most of your initial capital at work in 2008, 9, and 10, that's going to pay off in 14, 15, 16.
Yeah.
But we did, consciously make some decisions. Like we were very active in the secondary market, which wasn't very common for pension funds.
Yep.
There were a lot of institutional investors, endowments, and insurance companies that needed liquidity. Mm-hmm. And we were able to step into many of those funds at 50 or 60 cents on the dollar off of a pretty low NAV. And so that just sort of added to the primary commitments that we were making at the time. And we've always been active co-investors. Mm-hmm. And that co-investing has also resulted in better performance, frankly, right? Because at least if you do it right, mm-hmm. and you manage a portfolio, it reduces your fees. So I kind of credit it to those, sort of strategic initiatives, mm-hmm. but we do something interesting in that every portfolio manager rotates around the asset classes. And I think that's been a big help. So I started in private equity and venture, and then I moved over into fixed income and credit, and then real estate, and then equities and hedge funds. And so I think we have people in the room like that, and it's not huge. It's 10 to 12 people. You can have really substantive discussions about an idea. And I think that's something else that's probably helped us over the years.
I understand you made some changes last summer to restructure the overall asset categories of the portfolio, as well as reorganize the private markets portfolio. What drove that change?
It came down to the way we saw the world. There were really three types of asset classes. You had those that, you had something that you buy and you have to sell it to somebody else for more than you bought it. And we call that capital appreciation. So that's mostly like stocks, right? Stocks, private equity. But we were also doing a lot of opportunistic real estate. And we had a lot of operation exposure in energy. And so when you look at most pension portfolios, they look at real assets and real energy as kind of the inflation protection. Mm-hmm. But when we looked at our portfolio, when you're taking on, like you take opportunistic real estate, for example, there's no tenant, so there's no income that's tied to CPI at all. Mm-hmm. And our view was, look, we should make private equity and real assets just compete for capital because we saw it as the same risk. Mm-hmm. And we should just work with the top firms across those groups, but we should make them compete for each other. And in real assets in particular, we just thought that there were cheaper ways to do that.
So about a year later, how do you characterize the progress? And did COVID delay or change any of those plans? Or are you guys still pretty much tracking along?
Yeah, I think the voice in the back of your head, right, about cross correlations certainly is like getting louder and louder. Look, I think a pandemic is a negative expected value return, right? You can't build a portfolio on a pandemic, right?
Yeah.
But the other two asset classes that we set up were contractual income, where you're just clipping a coupon. And that started as direct lending, but it's moved more into special situations and royalties and leasing. Mm-hmm. And then the third portfolio is diversifying strategies, where you're trying to get 7 to 9% with little market exposure. Mm-hmm. And I think, it's too early to tell. I've been CIO for almost 2 years. Too early to tell, if the performance has been there. But we've done more co-investing, which was important for us, which I think will pay off long term. We've also created more of these, cliche strategic partnership agreements, right? Where we're working with firms that we have a lot of exposure with, mm-hmm. and just trying to deepen those relationships as long as we're not doing something stupid.
Right.
And I've been very pleased with that. I've been pleased with the operational turnaround. And I think probably the biggest initiative that we've implemented is forecasting. So you mentioned that I was a guinea pig on the forecasting project. And one of the things I learned was that in order to be a better forecaster, you had to be specific. I think you can't say, I think there's going to be a meaningful recession, right? Like in the next 2 months. You have to say, will GDP contract or grow at above this rate by June 30, 2020, and you have to give a probability score, like how confident are you that it'll happen? So we do that with all sorts of things, market prices, they could be ETFs, could be commodities, whatever. And we track them and we score everybody. I think that's been one of the best things we've done because it depersonalizes the discussion and it really gives a voice to some people on the team that tend to be quiet, right? Because we're going for truth. Mm-hmm. And frankly, it's usually the women, right? But they have the best scores. And so you look at it and we don't have enough data yet. Maybe 30 to 40 forecasts. But it's funny to see the intern and some of the women do so much better than the portfolio managers. It really does change the dynamic of the group discussion.
I bet. It must be humbling when the data shows it all.
Yeah, great.
So you mentioned that you had joined PSPRS in 2007. Obviously, that timing was quite critical.
Yeah.
Fast forward to today, you started at an intern, now you're CIO. We're again finding ourselves in 2020 in a highly volatile environment as well.
Yeah.
We have market forces. What has changed at PSPRS specifically, and what has also changed in your own investing style?
One benefit we had is that we were all around for the last crisis. So, and a lot of pension funds can't say that because they fired their team or whatever, right? I was an analyst, granted, but I was there. And one of our other senior portfolio managers was there. We worked with 4 consultants and they were all there. And so we had a playbook. And, you know, what we said was, first of all, don't get cute. You know, if you want to make 30%, you might just want to buy the thing that went down 30%, right? So a lot of people forget about, like, you know, they all went into like CLOs and leveraged loan funds and distress for control. But I think sometimes they forget, like, if you just bought the high yield index in like 2010 or something, you would have made like 55%. So I think step one was we had some experience where we actually were able to create a rule book and execute on that rule book. So it was, look at the liquid securities. Is there guilt by association? We know that the structured securities, it's just guilt by association. They will get obliterated. So let's look at the CLOs. Let's look at the REITs. Let's look at the MLPs. Let's look at the closed-end funds. Let's see where, you know, the value of the underlying is greater, right, than the NAV if it's in a fund. So it's knowing that there's going to be distressed sellers. So I spent the time on the phone talking to some of our private equity partners and some of our hedge fund partners, telling them, listen, somebody probably walked away from a deal, right? That you got hung. The dealer was, you know, the lender was there and they bailed. The equity holder was there, they bailed. But we're really ready to write checks. We're coming into this from a position of strength. So we moved all of our cash down to, we ran cash below 0.5%, and fixed income was down to 2%. And we'd put everything else in these transactions and overweighted our equity position as high as we could in the policy, so that, you know, we'll end up middle of the range for a pension fund, but we only had 23% equities. So I think we did pretty well. So I think what's changed for me is lots of things are diversified. Have a playbook, and don't get cute with it. Understand what you're buying, and just understand that it's a herd. It's a herd mentality, and you're probably long-term better off.
So you'd mentioned that you rotate your team members across asset classes, so everybody gets exposure and no one becomes siloed in a particular strategy asset class. You experienced that yourself. Why do you think that is important versus maybe building specialists? Because
we work with consultants, we sort of have the specialist angle. And, you know, we've been doing it since 2008. Now we're in the process of reevaluating those. So we'll do some RFPs, because just the portfolio changes, market changes, they change. So we always felt like we had on-point expertise. What we didn't have was sort of that amalgamation, you know, as a team where you challenge each other. There was one person in the room, like the private equity guy, who like was the only one that knew anything about private equity, right? Or the hedge fund guy, and, you know, and he's the only one that could talk about, you know, I don't know, vol arbitrage, which was boring. I mean, they all blow themselves up, but, like, you know, like stuff like that. And so we decided, look, once you hang around for 2 or 3 years in a fund, you know, we move you on to a different fund, and the discussions that we have as a group are 10 times better, because there's 2 or 3 people that sat in your seat that talked to the same groups of people, that had the same strategy conversation, right, with the consultant. And it's just a better discussion. It just is. And it feels bad, because the first time everybody gets rotated, the GPs will ask them, hey, what happened to you? What did you do wrong, right? So I tell them, I'm like, it's uncomfortable. I tell all of them it's uncomfortable, but I think longer term, you're better investors. Yeah. And so as CIO, you have to oversee all of these asset classes, but do you have a favorite, or is there, if you were to choose? Yeah, that's a good question. Nobody's asked me that before. I've got to have a favorite. I do. I like income producing strategies. And I would prefer to lever income producing strategies. Okay. I like private equity too. And I like US stocks. I've been less constructive on international. I've been less constructive on real estate and real assets. So that's where I think we spend most of our time.
So as a part of Two Sigma, our mission is to find value in the world's data. So I can appreciate the modeling and data-driven approach to investing.
Yeah.
And so with your own background in predictive analytics and forecasting, how do you marry the systematic approach to your portfolio management style?
Yeah, my brother calls it fortune telling. That's, I think, it's funny. I think that's why I like the income investments as much as I do. Because in stasis, you're going to get paid back.
Yeah.
And so the reason we have a strong sort of internal backbone in predictive analytics and data. And that's because I saw that's where the world was going. And we wanted to really understand what was going on in the model. We published a paper about 5 years ago. It was it won an award and published in the Journal of Quantitative Journal of Risk Management called Orthant Correlations. And basically it means you want, so we measure correlations with Pearson's R, right, which is an average. And what we figured out was you want one asset to be positively correlated to the reference asset when the reference asset is doing well. And you want the asset to be negatively correlated to the reference asset when the reference asset is doing poorly. And I remember talking to our head of risk, and I said, so what you're telling me is we just want something that makes money all the time, right? It's positively correlated when things are going up, and it's positively correlated when things are going down. You have to set a return threshold in there, so you don't just own treasuries.
Yeah.
But we came up with a relatively simple model to gauge those dynamic correlations. Outside of like illiquid securities, even then, as we have portfolio company data, we'll monitor changes in revenue and EBITDA. But I'm maniacal about correlations. I don't care about vol, because if you get the correlation right, the vol is not really the problem. So correlation is a big deal for us. The problem we've had with models a lot is just it's so hard to get away from overfitting, right? Because even if you have the most pristine sort of overfitting process, you still know more today than you knew last week. And even if you have that idea, like, well, what about this model? Well, it's usually informed by the most recent data. And so what we do, and we're not, we try to be sophisticated about it. We run time series models, we run neural nets, we run, unsupervised learning, just because we want to be able to speak the language. I think there's something there, but I do think there are a lot of groups that sell sources of data that you can use, or they'll do the data for you. And I just think that's table stakes. I think you have to come up with your own stuff, right? That just doesn't make any sense. Bringing it together, the way we handle that from a due diligence standpoint, because we only run it on paper right now, is we use sort of this what we call calibration exercise, which is, hey, you tell me in 12 months or whatever what the return will be. So let's call it 10% and give me a confidence interval, say 70%. And if we get there and you missed it and it was 8, we keep doing that on a rolling monthly basis. And what we'll find out is somebody's 65% confident all the time, but 45% right. So I don't even need to know what you're doing. I just know you don't know what you're doing, because that kind of mismatch doesn't happen, right? If you play it like a casino game where the odds are 65-35, right? But you think they're 75-25, you're gonna bet wrong. That's how we handle it.
That approach has probably evolved since the time that you've been there, especially in the seat as CIO. Where do you think that evolves to over the next several years? Does it become more and more ingrained in the process? Is it overlay?
I think it'll bifurcate, right? I think for pension funds, it'll become less relevant. I do think for firms like Google and Facebook, some of these other groups that have just large swaths of data, swaths of data, and their phones are being tracked. I think Facebook's one of the best venture investors out there, because they have so much internal diligence. And so they're, the more, if I take that aside, I just think the more active, the more public markets get, I think it's going to be easier, but I think groups have to come up with their own algorithms, right? They got to think about, what if I put this variable and this variable together?
Mm-hmm.
What if this is the variable we're seeing, right? I do believe in it. I do think there's something there. But the problem I see right now is that so many firms use the same type of data that, it's sophomoric, but it's like, look, if you crack the code, why are you talking to me? I'm a pain in the butt. That's the way I see it.
We'll watch for a flood of emails now that you've said that,
Yeah, well, yeah.
So maybe just add on the investment questions, what areas of risk are you most concerned with right now? Potentially ones that you think are being overlooked by other market players.
I think inflation might be there.
Mm-hmm.
There were the comments by Fed Powell. They're not even thinking about inflation right now, but there are some signs of it. So I think that's one. I think another one that concerns me is just the erosion of the U.S.-China relationship. I think antitrust is a big deal for the big tech companies, and I think the world has sort of forgotten about Europe for a while.
Yeah.
So those are kind of low probability but high severity events.
Sure.
That keep me up.
Yeah, and taken together could be catastrophic.
Yeah, exactly.
All right, so I'm done with the business questions. Thought we could pivot to some fun questions. And I hope you'll let me take it here. I noticed you're involved with a performance group, Cinematic Pop. And so for those who don't know who are watching, and I've had the pleasure of watching some of the performances, Cinematic Pop performs, but really I thought is transforming popular pop songs with classical music arrangements, full orchestra, choir. So would love to hear how you got involved.
Yeah, sure. I was a classically trained singer in college. So when I grew up, my parents said you have to do music and you have to do sports.
Okay.
And those are the rules. And so I grew up a singer, and I found it was just really meditative for me. But I wasn't going to be a vocal performance major. It wasn't going to be my job. They don't make any money. And my mom was very clear about that. So I just I made it through all the competitive organizations at BYU where I did my undergrad, and stayed very active in the community. And there's a conductor here he's a professional. He'll just kind of use word of mouth to get us singers. And if somebody thinks you can sing, he's fine with that. That's how he rolls. So what's interesting about this though is he created Cinematic Pop, and he's like, look, we're going to just make a bunch of YouTube videos, like 7 or 8 of them. We'll take popular songs, send them, we'll set them sort of like cinematic classical scores. And I thought it was kind of cool because I was like, all right, some songs don't appeal to people that maybe in a different medium they do. So we put them on YouTube, and then we got a call from America's Got Talent. And that's when they said, hey, we think you'd be good about, we think you should come on the show, but we can't take all like 40 of you. We can take like 12 of you. And so we went to America's Got Talent. We got 4 yeses. That's on TV.
That's great.
But we couldn't come to terms with what they basically want a royalty for anything, like anything you do ever again, even if it has nothing to do with Cinematic Pop.
Oh.
And we all had day jobs, and we're just like, whatever.
Yeah.
We didn't care, but it's fun. It breaks up the monotony.
Yeah, I'm guessing that's probably your most favorite performance that you've performed with the group, or have there been others?
Like America's Got Talent.
Yeah, was that a memorable performance itself?
It was
much smaller scale, it seems like, in terms of.
Yeah, it was memorable. They perform here at the Mesa Arts Center, which is maybe 3,500 people, and they'll sell out. They'll do a couple concerts in a day, and they'll sell out. America's Got Talent is kind of weird because they force you to come into, like, you have to report at like 6 a.m. And then you're just in this back room.
Yeah.
And they make you sit in the back of photos as they interview other singers. So it looks like, but you can't leave. They'll be interviewing this person who does magic tricks, and they'll be like, hey, can you stand in the back behind him? And we had like a cellist. We had like, we had people with instruments. Yeah. And we're sitting there for 45 minutes, and we're like, hey, we have to go to the bathroom. And he said, we'll probably be another 20 minutes. So you spend the whole time, like, you're so tired by the time you get on stage. You've been there for like 8 hours, right? And so it was memorable like that. It's not that sexy.
Yeah. So related, what's your go-to karaoke song then?
Yeah, it depends on the mood. I try to read the audience, right? I'll get Folsom City Blues from what's his face? Hurt, Folsom City Blues, Johnny Cash. Thank you, Johnny Cash. I'll do that one. I'll do the Pina Colada song. That's always a crowd favorite. Always a crowd favorite. And then whatever my wife signs me up for, she's a.
So you're ready to go across genres.
She's a Jan 1 birthday, so we have to stay up New Year's Eve to celebrate her birthday. Her birthday is January 1st, and then on her birthday we have to all go out and do karaoke. So there's usually a couple songs. Eminem will show up. That's pretty common. I can do some Elvis. I actually do Elvis pretty well.
Nice. Okay.
Yeah. That doesn't do well with the ladies, but I'm married now, so who cares?
Oh, that's great. Since we're all working remotely and we can't come visit you, what's your favorite thing about the Phoenix area? It's
clean. It is a clean city. And I think that's what happens when you don't have rain or snow. It's clean. Traffic isn't bad. The sun is out most of the year.
Yeah.
And I didn't think that was a big deal until I went somewhere where the sun is not out that often, and I just felt tired and lethargic.
Yeah.
So I don't know. Where are you based out of? Are you in New York?
I am in New York, where we don't have as reliably sunny days, although we've had a pretty good summer for the most part. It's pretty, but pretty hot, which I don't think I can complain with you on. But it's more humid here, so.
That's brutal. That's brutal.
The heat can be pretty bad, but yes.
I've been stuck in those trains that come from, you're waiting in Connecticut, and then it's late, and then it's like everyone's on the train and the bathroom's broken.
Oh yeah. And the AC is broken, and you found yourself next to the largest person on the train.
Yeah. Man spreading.
Yeah. Yes, indeed. But yeah. Well, all right. Well, thank you for spending the time. This has been really great, and we look forward to our chance to come down to sunny Phoenix at some point. Hopefully, when all of this is rolled over, and really appreciate the time, Mark.
Hey, you're always welcome. Thank you so much.
All right. Thanks.